नमस्कार, welcome to the program ज्ञान से कल्याण. My dear friend, today we are proceeding, which we have started, basics of accounting for class 11, 12, BCom, BBA, BCA, MCom, MBA, CA, CS and ICWA. So, this is the beginning of the accounting. So we are discussing here the basics of accounting. So myself here brief introduction is given. Dr. Vaidyanath Ram Prajapati. So today we are going to discuss very important concept, that is capital and revenue. So what are the difference between capital expenditure and revenue expenditure, capital income and revenue income? So this is the backbone of our accounting. Until and unless we understand the distinction between capital and revenue, we will not able to record the transactions in the books of account. Without understanding, if we are recording it, naturally there may be mistake and our whole thing will go wrong. The picture will not be clear. The financial statement, that is trading account, profit and loss account, balance sheet, and in case of non-profit making organization, in revenue, income and expenditure account, receipts and payment account, and balance sheet may wrong. So here we are discussing the concept and difference between capital and revenue. So the distinction has important implications for making, just I explained, trading and profit and loss account and balance sheet. The revenue items forms part of the trading and profit and loss account. The capital item helps in the preparation of the balance sheet. So following are the important difference between capital expenditure and revenue expenditure. So the first and very important difference is capital expenditure increases earning capacity of the business. It enhances the earning capacity, or we may call that it is the basics of developing infrastructure for generating revenue. So revenue expenditure, on the other hand, it is spent to maintain the earning capacity. Just we are taking one example. If we have taken a building, so building is an capital expenditure. Whatever the amount we have invested on building, it will be shown in the balance sheet, and the maintenance of that if there is a wear and tear, there is a repairing, whitewashing, so these all are the recurring expenditure. So this is the maintaining expenditure, so it maintains the earning capacity. So capital expenditure, on the other hand, incurred to acquire fixed assets for operation of business, whereas revenue expenditure is incurred on day-to-day conduct of a business. So next very important difference. So revenue expenditure is generally recurring in nature and capital expenditure is non-recurring in nature. So next difference is capital expenditure benefits more than one accounting year. This is long lasting. This is not for selling purposes. Whereas Revenue expenditure normally benefits one accounting year. It adjusted in one accounting year. We are transferring it in the trading and profit and loss account, and the revenue account is closed in that particular year. So next very important difference is capital expenditure subject to depreciation, whereas revenue expenditure is require adjustment for outstanding. Prepaid expenditure and outstanding expenditure, these all are adjusted. So now we are proceeding to the other very important part. What are the basic objectives of preparing financial statement? So here the basic objective is to show and to present a true and fair view of the financial performance of a business, of an organization. It also presents a true and fair view of the financial position of a business, and for this purpose the firm usually prepare the following financial statement. Just we have discussed. The first one is trading and profit and loss account, which shows the operating result. The next one is profit and loss account, which shows the net profit or loss. And the next one is the balance sheet. This shows all the assets and liability, what company owes and what the other party owes to the company. So my dear friend, we are discussing the concept of gross profit and net profit. So gross profit is equal to sale minus net purchases, and net purchases plus direct expenses minus purchase return. So likewise we are getting the net profit, gross profit minus indirect expenses plus other income, or net profit is equal to gross profit plus other income minus indirect expenses. So here one very important question test is given. So this is true and false. Some of the options are given. So you have only to tick which one is the true or false. So first one is gross profit is the total revenue, whether it is true or false. So for your reference purposes, I have given answer somewhere. So you try first yourself and then you match it. So test number second is given matching A with matching B with the correct answer. So here some of the A and B are given. So you only have to match it. Like closing stock is credited to trial balance. So these all are the various items. So now we are going to discuss what are the items which are shown in the balance sheet. So in the balance sheet, we are showing the fixed assets and the long-term liabilities, current assets and the current liabilities. So fixed assets are those assets which are held on a long-term basis in the business. Such assets are not acquired for the purpose of resale. Here some of the examples are provided: land, building, plant and machinery, furnitures, fixtures, some items, and these items are also called fixed block or block capital. So there is another items which are intangible assets. The assets are grouped or classified under two parts, tangible and intangible assets. So above we have discussed, these all are called tangible assets because we can see it, touch it, But on the other hand, intangible assets which cannot be seen or touched. Here some of the examples are given: goodwill, patent, trademarks. So here we are proceeding items in the balance sheet. Next item is the investment. Investment represent the funds invested in government securities or shares in company. They are sold at cost price. On the date of preparation of the balance sheet, the market price of the investment is lower than the cost price. A footnote to that effect may be given. So here answer for the test 1 and test 2 is given. So you first do yourself and then you match with these answers. So capital assets, again we are quickly revising it as we have seen in the previous slide. The fixed assets are called the capital assets. This is long-lived assets. This is used in the operation of a business and this is not intended for sale to the customer. So these all are the basic features of the fixed assets or capital assets. As we have seen, these are divided under two parts into two categories, that is the tangible assets which have the physical substance and intangible assets which have no physical substance. So tangible assets includes property, land, building, plant, machinery, and it also includes natural resources such as mineral deposit, oil and gas reserves, timbers, etc. So as we have seen, property, plant, land, building, these all are the capital assets or fixed assets. Property, plant and equipment can be classified land, land improvement, buildings and equipment. So and intangible assets, here examples are given: patent, copyrights, spot contract, trademark, etc. How we can determine the cost of capital assets? This is very important. Until and unless we are determining the cost, we will not record it in the, and we will not able to record and show it in the balance sheet. So it is recorded under cost principle. So the cost consists of all expenditure which are necessary to acquire the asset and which is incurred to make it ready for use. The cost include purchase price, freight cost and installation cost. Expenditure that are not necessary should be recorded as expenses and losses, and which will not be added to the fixed assets and it will be debited to the trading and profit and loss account. How we can measure it and what are the method of measurement? So cost is measured by cash paid in cash or cash equivalent price, which is non-cash, in the form of assets, or it may be debentures or shares. So cash, how we can determine the cost of land? It includes cash purchase price, closing costs such as title and legal, real estate broker commissions, and accrued property tax like GST. Land improvement. The cost includes all expenditure necessary to make the improvement ready for their intended use. So here some of the examples of land improvements are given. This is very important: parking lots, fencing, landscaping and lightings. Next item is building. So the cost includes the purchase price and the closing cost, real estate broker commission, etc. The cost to make the building ready for its intended use. It consists expenditure for remodeling and replacing or repairing of roof, floors, wirings, plumbings, etc. And the another, if a new building is constructed, it cost consists the contract price plus payment to architect, fees, building permits, interest payment during the construction period, and excavation cost. Equipment, the cost include all expenditure required to installing and testing the units. It also includes recurring costs such as licenses and annual insurance or expenses as incurred. Amortization, it is the process of allocating expenses to the cost of capital over its useful life. So, it is very important for the matching principle that all the intangible assets should be amortized over a period. Land is the only capital assets which has not to be amortized. So there are certain method of amortization. So these are the methods: straight line, units of activity, and declining method. These all methods are generally accepted under generally accepted accounting principle. So management may select any of the method and it may continue, and it should not be changed so frequently under the convention of consistency. So here straight line method formula is given. So we all know in the straight line method amount of amortization value is fixed. Here we are taking one very important example. If the total cost of patent or goodwill or trademark which is to be amortized is 10,000 and life is 5 years. So we will divide 10,000 by 5. We will get the value to be amortized over the period. That is the 2,000 that will be amortized in 5 years. So here how we are getting the amortizable cost. So total cost of assets minus residual value if there is any. So any scrap value is there. So that will be deducted from the cost of assets. So here for determining cost minus residual value, amortization cost, and amortizable cost divided by useful life is equal to amortizable value. So here expenditure during useful life, ordinary repairs are expenditure to maintain the operating efficiency and expected productive life of the capital assets. So these all are the recurring expenditure and these all are debited to the repair expenses account. And additions and improvement are the cost incurred to increase the operating efficiency and productive capacity or expected useful life. So this is a very important thing. There are three concepts are explained here. If any expenditure which enhances operating efficiency, productive capacity, or expected useful life. So it is added to the capital assets. How the capital assets are disposed and what are the different methods by which we can dispose the fixed assets. So here some of the methods are given: by retirement, by sale, or by exchange. So if the disposal occurs during the year, amortize the assets from the beginning of the year to the date of disposal. So eliminate the net book value of the capital assets at the date of sale by debiting accumulated amortization value and crediting the fixed assets. So in case of tangible assets, we are debiting the depreciation and crediting the fixed assets. If the accumulated depreciation account is maintained, we will debit the depreciation and we will credit the accumulated depreciation account. Natural resources. So here some example of natural resources are given. Deposits of oil, gas and minerals. So these are frequently called wasting assets. There are two important features. They are physically extracted in operation. They are replaceable only by the act of the nature. No human being can replace it. Just take the examples of coal mines. So if we are extracting coal from the coal mines, we cannot replace it. Acquisition cost. What are the acquisition cost of natural resources? So here natural resources is the cash or the cash equivalent price necessary to acquire the resources and prepare it for its intended use. So if the natural resources are already discovered, cost is the price paid for the property. So how we can amortize it? So some rational or systematic manner over the useful life we can amortize it, so that is called amortization. So here we are using the units of activity method. Generally used to compute it, this method is used. So periodic amortization is a function of the unit extracted during the year. So here intangible assets, just we have discussed. This may be rights, privileges, competitive advantages. It results from the ownership of the long-lived assets that do not possess physical substances, as we have discussed. So here how we are determining it, how this is created. So intangible assets may arise from the government grants, acquisition of another business, and private monopoly arrangement. How we can record it? Generally, accounting for intangible assets are recorded under capital assets. These are recorded at cost and it is written over its useful life on the rational manner. So we have already discussed how we can make the journal entry in our previous chapters. So to record amortization expenses is debited and the specific intangible assets is credited. So patent is an exclusive right issued by the government that enables the receiver or recipient to manufacture, to sell, or otherwise control his or her inventions for a particular period, say 20 years. So how we can determine the cost? So here some of the items as an example is provided. So it may be the cash price which is paid or the price equivalent which may be other than cash. So it also includes the legal cost which is incurred for defending the patent. So copyright, we all know this is the right granted by the government which gives the owner the exclusive right to reproduce and sell an artistic or published work. Copyright may extend for 50 years or as the government decides under its policy. So the cost of copyright may consist cost of acquiring or defending it. Next item is trademarks and trade names. So we all know and we are familiar. It is a symbol that differences or distinguishes or identifies a particular enterprise or a product than other one. The cost of trademarks may be if the trademarks is purchased, the cost will be the purchase price, or if it is developed by a company, so it includes the legal fee, registration fee, design cost, and successful legal defense fee. So we are proceeding to the other part, franchises and licenses. A franchise is a contractual agreement or arrangement under which the franchisor grants the franchisees the right to sell certain product or renders specific services, or it may use certain trademarks or trade names which is designated geographical area. So this is given under certain part of the state or the district or a village or a town. So geographical area is provided in which it can be applied. Another type of franchise is commonly referred to as a license or a permit. It is entered into between a governmental body and a business enterprise and permits the enterprise to use public property in performing its services. Next item is goodwill. As we know, goodwill is the name, fame and reputation of a business, and it may be the value of all favorable attributes that is related to a business enterprise. These attributes may include exceptional management, desirable location, good customer relation, and skilled employees, and as well management. So it cannot be sold individually, it is sold along with the business. So how we can record it? It is recorded only when there is an exchange transaction, or if it is purchased, that involves the purchase price. How it is determined? So when an entire business is purchased, goodwill is the excess of cost price over the fair market value of the net assets. Net assets is total assets minus liability acquired, or we may say total assets acquired is deducted from the price paid for acquiring it. If the price paid is more than the asset acquired or net assets acquired, that is called goodwill. Very important item, my dear friend, research and development. This is the very important item for any organization for the growth and development. A business can only survive if it regularly doing research and development activity. In the modern age, we all know there is a changes, every day changes occurs. So it is the cost pertains to expenditures incurred to develop new product or process. So it cost may be determined the expenses when incurred, development cost which is reasonably assured, future benefit which may be capitalized, otherwise they too are expensed, or it may be a revenue expenditure. Now we are proceeding to the presentation of financial statement. How we can present it by either way, by permanency way or the liquidity way. In the permanency way, we are showing the permanent assets at the top and the permanent liability at the top on the liability side, and current assets and the below of the fixed assets and the current liability at the below of the long-term liability. So in the balance sheet, property, plant and equipment, natural resources and intangible assets are shown under the head fixed assets, that is called capital assets. There should be disclosure of the balances in the major classes of assets and accumulated amortization of the major classes of assets or the assets in total. So how the assets is utilized? What is the efficiency of the assets which is utilized? It is measured in relation with the sales which is produced. So the ratio that shows how efficiently a company uses its assets to generate sales is called assets turnover ratio. So here one very simple formula is given: net sales divided by average total assets gives us assets turnover ratio. And here, my dear friend, average assets is calculated by opening assets plus closing assets divided by 2. So this is called average assets. Next one is return on assets, or it is the ratio that shows the profitability of assets used in the earning process is called assets or return on assets. Net income divided by average total assets gives return on assets. So this measures the profitability of assets. So here, my dear friend, a brief introduction of the trust on behalf of which we are working is given. So this is the Vishwa Manav Kalyan Charitable Trust, which is a trust dedicated for the welfare of humankind. Thank you very much.